Now that we know how to identify and map out supply and demand zones, whether it be range created supply or demand or pivot created supply and demand, now we can move on to the different types of these zones, whether they be continuation or reversal type models. So right here, what we have are continuation models for supply and demand. Now, building on to what we learned of the creation of zones in the first video, we're going to be looking at the continuation of demand and supply using ranges. Now, if we're looking at continuation patterns using these models, what we would see for a continuation demand model would be that you'd have an impulsive move to the upside. We'd be seeing a market moving to the upside. We would see that range being created, that sideways price action. We would then see price expand out of that range rapidly. And again, we're not trying to trade the break of that range, but instead we're waiting for price to return back into that range, that demand zone, to look for our entries. And on the flip side, if we're looking for range created supply of our continuation supply model, we'd be seeing price moving to the downside rapidly. We'd see that sideways correction. And again, we'd see it expand to the downside. Again, we're not looking to trade the initial break of that range, but instead we're waiting for price to return back to the supply zone, and that's where we'd be looking for our entry. Now we move on to pivot created demand and pivot created supply. Again, based on the first video, we have our pivot, which is a sharp move to the upside. And this can take shape of a few corrections as well within it, but generally speaking, the concepts are still that remain the same, where we have that sharp move to the downside, which is important, and then we get that rapid expansion away. Again, we're not looking to trade the initial expansion away from that pivot, but instead we're waiting for price to come back down into this demand zone and look for entries. Now, if we look at the pivot created supply, again, we have a sharp move to the upside, followed by an expansion to the downside. We're not looking to trade the break of that pivot, but instead waiting for price to return back to that supply zone to look for entry. Now, the reason these are continuation models is price was already moving to the upside before the pivot was created that created that demand zone, or price was already moving to the downside before it created that pivot that created the supply zone. We are basically just looking for price to be continuing in that direction, look for our footprint, and then wait for price to return to those zones. Now let's take a look at the reversal demand and supply models, again using the same zone creation model. So if we're looking at range created demand, we're looking for a move to the downside. We have that sideways range. Price then expands to the upside rapidly. Again, we're not looking to trade the break of that range. We're waiting for price to return back into that demand zone to look for entry in that newly created demand zone. Now, if we're looking at a reversal supply model using the range created supply, we'd be looking for price coming to the upsides, likely in an uptrend prior to that. We create a sideways range and then an expansion away to the downside of that range. Again, we're not looking to trade that initial break of the range, but instead we're waiting for price to move back into that newly created supply zone, that range, to look for our entries. And now we can look into the pivot created demand and supply reversal models. And similarly to the reversal demand model created by a range, we get that sharp move to the downside followed by an expansion away. The difference being with the range is we actually have that clear sideways range, whereas with the pivot, you almost get a double pivot where price creates a low, moves up, doesn't really go too much further. We move to the downside rapidly, create that pivot in price, and then price expands to the upside. This entire move is what formulates that demand zone. Again, we don't look to trade the break of that initial high. We're instead waiting for price to return to this newly created demand zone to look for entries. And then finally, we have our pivot created supply. And this, again, is created from an up move. We get a low that's created, then we have a sharp move to the upside and a break to the downside, a rapid move to the downside. Once again, we're not trading the initial break. We're waiting for price to return back to this newly created supply zone to look for entries. Now that we've gone through the models of supply and demand, whether they be the continuation or the reversal models, let's conceptualize this a little bit further and actually introduce the concept of candlesticks so that we can see a more clear and clean-cut example of what we would actually see on a price chart. So if we look at range created supply and demand, what we can see quite clearly is we have this sideways price action. For every down move, we get an up move, down move, up move. Price is contained within that overall range in price until we see a rapid move to the downside. Again, we're not looking to trade the break of that range, but instead we're waiting for price to return to this newly created supply zone to look for sell trades. And on the flip side, for the range created demand zone, we have this sideways price action. We see that rapid expansion away from this range, and we're waiting for price to return back into the demand zone to look for buy entries. Another way that you can draw range-bound supply and demand, also using the concept of pivot supply and demand, and this is where the two can be interchangeable, is when you have that overall range in supply, what you can see is we have two candles, two up candles, and then we have this massive move to the downside. We can draw our supply zone using these two bullish candles before the large move to the downside, and that would build up our supply zone. And what we can see, if we just very quickly move this over, from a drawing perspective, the zone has not changed in size. It just becomes a little bit more specific to the up moves that see this large move in price. Coincidentally, alternatively as well, if we just look at this range created supply really quickly as well, using this idea, we can actually also draw our supply zone just on this first candle. So we have a few options, and it really comes down to personal preference on which way you prefer to draw your supply and demand zones, especially when they are range created. Sometimes the ranges that are created are simply too large to really work with, and this is where you have the flexibility to also put your attention to the last bullish candles before that move to the downside, or the last bullish candle before the move to the downside, depending. If we have 2 or 3 bullish candles before that large move, that implies a pivot. And if we have 1, it's still a pivot, but it's a little bit more refined within the overall range in question. And the same is said with range demand. With a pivot zone creation, we have 2 bearish candles and then the rapid expansion outside of that range. Again, if I just move this over, the range would be exactly the same in this example, but it just refines it to a little bit more clean-cut way or approach of drawing or mapping the demand zone. Again, we can also use this one and just draw it on this last bearish candle before the rapid move to the upside, because again, in both situations, we are waiting for price to come back down into this newly created demand zone to look for entries. Again, this ultimately comes down to personal preference on how you want to map your candles, especially when you see range-bound or range created supply and demand zones. Essentially what you can do is wait for that range to be created, map out the entire range, look for price to move to the downside or the upside, and then simply wait for price to return to that entire range to look for an entry. That gives you more flexibility in terms of where price will return to look for an entry, whereas you can also simply mark just the bullish candle before that bearish move or bearish candle before that bullish move. Or if you have 2 bullish candles before that bearish move, you can use those, or 2 bearish candles before the bullish move. A little bit of flexibility, but again, it ties back to what makes the most sense for you and can be situationally dependent on if you have a very large range and conceptually the pivot or singular candle makes more sense to mark, then that ideally is the best route to go. Now, what we can also do is look at the pivot supply, pivot demand. And again, this factors into what we were just speaking about, where you have single candle creation and multiple candle creation of these supply and demand zones. If we're using pivot supply with a single candle creation, basically we have that bullish candle before the bearish expansion outside of that pivot. If it was a continuation pattern, we would have something like this, where we have that down move, the sharp move to the upside, and then the sharp move to the downside. So it's conceptually the exact same as what we had just spoken about. And what we would see within this candle as well, just to drive the point home a little bit more, is this single candle on a lower time frame, more specifically, is likely a range as well. And this is why you're able to factor in a single candle on a range as your supply zone in this case, or a series of candles within that, because this in itself is a pivot and this in itself is a range. So they are interchangeable, and that's why you do have the flexibility. Again, this is where it really comes down to testing them on the chart, seeing which really resonate with you. For some, ranges will just be the way to go. For others, it will be simply looking at single candles, because also what you can do, if you prefer, is drawing your supply zone using just one candle instead of the succession. There are just multiple ways of drawing out supply and demand zones using these creation methods, and it really comes down to testing, experience, and really just getting comfortable with the premise of supply and demand and what is ultimately happening on the charts, because price is fractal, and what you'll see on a lower time frame can also be included in just one candle, and we'll expand on that a little bit later on. But again, when we're coming back to pivot supply and demand, we have the single candle, which if we're looking at a reversal model would be something like this. There's your pivot, would be that right there. Or if we had a continuation, there's your pivot, and we're just drawing it on that singular candle. And the same can be said for the multiple candle creation, where we have something like that, where we have this pivot in price, or if we have a reversal, we have that pivot in price. Regardless of how you're looking at it, all the models remain the same in what we're looking to do. We see it being created, and it's our job to map out the zone in which way that we feel is the most high probability for our trading style. So regardless if we're trading range-bound created supply and demand or pivot, we have the opportunity of drawing our supply zone using the entire range. We can use the bullish candle, we can use the series of bullish candles, and on the flip side for demand, we can use the bearish candle, we can use the entire range, or we can use the series of bearish candles. And what we're doing is, now that we've established that prices rapidly move to the downside or prices rapidly move to the upside, we've been able to identify that a supply zone or a demand zone has been created. We just simply are waiting for price to return back to that supply zone. So we have that flexibility in understanding where price could go. Will it return to the entire range and fill to the upside, or will it focus on just this candle? We don't necessarily know where it's going to go. The only way we can truly know is if we do enough testing, get a large enough data size, and figure out probabilistically which tends to be more effective, especially for your trading style.